Tesla announced record revenue this quarter. The very next day, however, it experienced its worst day in a year. Looking at the numbers, this doesn't seem obvious. Tesla generated $28.2 billion in revenue this quarter, a 26% increase compared to the same period last year, a quarterly record. It delivered 480,000 vehicles, the first year-over-year increase in almost 2 years. This record figure is 34% higher than the previous quarter, meaning the company has truly emerged from a 2-year downtrend. So sales look great. But the picture changes completely on the next page. The company's actual profit margin was just over 57%, only $398 million. Cash flow went negative for the first time since 2024. Investor reaction was swift, a 14.5% loss in a single day, falling from $374 the previous day to $319 the next. So how does a company record sales while still making money? The answer lies in 3 places. First, the previous quarter looked somewhat artificially good thanks to one-off warranty improvements and tariff refunds. So it wasn't so much that this quarter was bad, but rather the more brilliant bursts of activity that characterized the previous quarter. Second, Tesla's revenue from emissions credits sold into other car components is shrinking. Think of it this way. Some traditional car manufacturers need to stay below a certain emissions threshold. Those who don't make electric appliances can't hit that snag, so they buy credits from zero emissions like Tesla. For Tesla, this was revenue that went directly into profit with virtually no production costs. As this revenue shrinks, a significant backbone of profit is lost. Third, operating expenses increased by 47% year over year. Much of this is no coincidence. Tesla is planning to invest over $25 billion in AI battery production and evolving products by 2026, almost 3 times the amount invested last year. This investment in robo-taxi and AI planning is stealing from today's profits, but according to the company, it's being invested in tomorrow's growth. So Tesla is selling more cars, but the portion of its revenue that remains in its pocket is being squeezed by 3 separate projects simultaneously. This is actually a trap that has been seen many times. A company's sales figures grow, it makes headlines. But if the profit margin erodes, that growth doesn't really benefit the company. You're just selling more products at less profit. This is the real fear of investors. Even if the revenue figure is impressive, it's unclear whether this will translate into a sustainable profit model. The company says it's investing in potential today, but that future isn't yet proven. It's just a gamble. Therefore, the next time a company announces record revenue, ask one question. How much of that revenue actually translates into profit? And how much is just a big number?